Okay, we are live now. Good evening and welcome to this month's AMA session. My name is Simran and I'm part of the Gulaq team at ST and I would be moderating today's session. Unfortunately, our key speaker, Mr. Vivek Sharma, could not make it today due to some urgent work, but we have with us today Ankit Kejriwal, who is part of the research and content team at Gulaq. Welcome, Ankit.
Thank you, Simran. Hi, everyone. As Simran has introduced me, my name is Ankit Kejriwal. Unfortunately, Vivek had to be somewhere today unexpectedly. So I'm filling in for Vivek. I'm going to be taking you through the portfolio updates and previous month's performance. Uh, since we had already rolled out all the communications regarding this webinar, so we did not wanted to cancel this or reschedule it. So I'm just going to be taking you through the updates, and you're going to see Vivek next month as usual.
Thanks, Ankit, for filling in for Vivek today. So, just to let everyone know, we do these YouTube sessions monthly, wherein we mainly cover two things. The first one is to walk you through the monthly performance update and also just a quick review of the performance. And the second one, just as important, if not more, is the AMA part, wherein we provide you a space where you can directly ask your questions to our investment team. So it can be any question, might be about how our portfolios are constructed, how our stocks are selected, or even if you have any questions about your personal allocation, this is a space to ask. So feel free to drop your questions as we go, and we'll take them right up after our update. So let's just set the agenda for the webinar. Ankit, if you can just share your screen, please. I will give you the permission. I think you should be able to share your screen now.
Let me know whenever the screen is visible.
Yes, the screen is now visible. So, starting off with today's agenda, as always, we would be giving you a brief background about ST and Gulaq, especially for people who are new here. Then we would be covering the rebalance portfolio update and talking about our performance. And in the end, we will be working with the AMA session, which we have divided into two parts. So, in the first part, we would be addressing the questions which we got prior to the webinar through Google Form. And in the second part, we would be taking live questions from the audience. So let's get started. So, just to give you a brief background about ST, which is the parent company of Gulaq. So, ST has been here since around 2008, and we are actually one of the early players in quantitative investing in India. So, for many years, we have focused on institutional and high net worth clients through our PMS strategies. So, the core idea over there was simple, that we need to use data and technology to take out emotion out of the investing. Since then, we have grown and are currently managing an AUM of over 1500 crores. After that came the idea of Gulaq. So, where we asked ourselves a simple question, that why should sophisticated investing be limited only to a few people? So, Gulaq is our answer to that. It is a platform where you can get access to the same core philosophies, the same research backed strategies, but with lower ticket sizes and far more accessibility. So far, more than 25,000 investors have trusted and used Gulaq portfolios on their investing journey, and we're just getting started. So, moving on to the next slide, this is the team behind our Gulaq product. Sandeep Tyagi is our founder, CEO, and the driving force behind ST. He is an IIT Delhi and Columbia Business School graduate with more than 30 years of experience in finance and analytics. And of course, Mr. Vivek Sharma, who is our investment head, who usually does these webinars, has a background in engineering from IIT Kharagpur and brings decades of market experience onto the table. Their shared goal, along with everyone at ST, is to help all our investors cut through the noise and make more confident and informed investing choices. Moving on to the next slide. So, This is a quick compliance note. As a SEBI registered research analyst, we are required to remind you all that investments carry some level of risks. So, one should read all the relevant documents carefully before you make any investment choices. And just to be clear, any securities mentioned today are only for educational purposes and shall not be treated as buy and sell recommendations. And now for the main part, Ankit is going to walk you through this month's portfolio rebalance, what's changed, why we made those decisions, and what it means for your investments. So over to you, Ankit.
Thank you, Simran. So, if you have been a regular visitor to these webinars, you would know that at ST we classify our portfolios into two buckets. We have our gear-based portfolios and we have our market cap-based portfolios. Gear-based portfolios are basically the same portfolios, exactly same portfolios. Just the only difference between these portfolios is the asset allocation. So several studies have shown that asset allocation is the best way to control the risk exposure towards the portfolio. So we design these portfolios using the same equity exposure. The only difference is the debt component. So Gear 6 contains 100% equity, Gear 5 contains 80% equity and 20% debt, and we just keep increasing the debt allocation by 20%. Uh, and obviously, the risk appetite is from aggressive to most conservative. So most aggressive investors should choose Gear 6 portfolios, and most conservative investors should choose Gear 3 portfolios. If you haven't already, you should visit gulaq.com and take the risk survey to identify which portfolio is best for you. Now, coming to the portfolio updates, in terms of market cap allocation, nothing much has changed. We have effectively maintained the same allocation. Large cap is just around 40%, mid cap around 42%, and small cap is still around 18%. In terms of industry allocation, we have allocated slightly more towards industrials and we have divested from healthcare this time. So, and rest of the sectors, it's pretty much the same. In terms of factor weights, so if you're not aware about our methodology, we use factor-based investment methodology. Basically, these are the driving force behind the returns of the markets. So these are the underlying return drivers. So quality, volatility, momentum, leverage, and value. These are the recognized, rewarded systematic risk factors that tends to drive the returns in the market. And in this, our allocation is effectively the same as we have been maintaining since May. So our allocation is towards value and quality because these factors tend to perform pretty well during scenarios where market is in a flux and especially in a situation where market volatility is high, these factors tends to perform well. Coming to the performance, last month, Gear portfolio produced a negative 1.6%. However, Nifty Multicap produced negative 3%. So, in terms of relative performance, we outperformed the index by 1.4%. Over the longer time period, 3 years, 6 months, we are still outperforming the index by slight margin. Over a 1 year period, we are underperforming the benchmark. However, if you compare the performance over a longer period of time, especially since inception, which is over 5 years period, we have produced a pretty sizable amount of alpha, which is of over 20%. Now, this is the same table, just producing the numbers for Gear 5 portfolios. It's the same pattern because effectively all these portfolios are same, just the debt and equity allocation is different. This is for Gear 4. We introduced this portfolio slightly later and hence it has shorter performance history than the rest of the peers. And this is the performance of Gear 3, which is basically meant for conservative investors. And here is a snapshot of all the portfolios at one go. And all these performance you can download from smallcase.stadvisors.com. So smallcase itself computes all these returns. We don't compute this ourselves. So if you want to verify and compute these returns yourself, you can visit our microsite, which is smallcase.stadvisors.com, and download the index series and compute these returns. Coming to these chart, basically, it's good to look at what 100 rupees invested would be today. So if you had invested 100 rupees since inception in our portfolio, what would that 100 rupees be today as compared to with the benchmark? So from this chart, you can see that if you had invested 100 rupees since inception, which is May 2020, your 100 rupees would have turned out to be 683 rupees today, which is almost 44.2% compounded annualized growth rate, which is a phenomenal return as compared to the benchmark, which would have done 302 rupees, generating approximately 23.5% CAGR. So we have outperformed the benchmark almost 2x. And on the right side, you can see the bar graph of year on year performance. So as you can see, we started the portfolio in calendar year 2020. So we didn't even had the full year of performance history for calendar year 2020. We launched in May. So effectively, it's just the second half of the year. However, as you know, the market quickly recovered from that COVID downfall in this H2 of 2020, and hence we are seeing such an amazing performance in that year. And going forward, we have basically outperformed every single year except for calendar year 2024, where we were doing pretty well till H1. However, we started seeing pretty negative returns because of heavy outflows from foreign institutional investors. But still, we weathered the storm and closed the year just about the same returns as benchmark. And this year, calendar year 2025, year to date, we are slightly underperforming the benchmark. Now, coming to the market cap portfolios, we have discussed all the gear portfolios performance. Now, the market cap portfolios, we have three market cap portfolios. So, large cap, mid cap, and small cap. So, as you know, large cap are the top 100 companies by market cap. Mid cap is the 101st till 250th company by market cap. And small cap is the remaining 250 companies by market cap. So what we do is this is the defined universe of these portfolios, and what we try to do is deploy the same factor-based investment methodology and select 15 to 20 most optimal stocks from this universe that we think are going to best perform in the coming months. The portfolio construction approach is still the same. It's quantitative, sector agnostic, and a systematic approach. We still do the monthly rebalancing. So effectively, everything is same. The only difference is the market universe. So the universe of the portfolio for Gear 6 is BSC 500. For these market cap portfolios, it's their respective market caps. Coming to the performance of these portfolios, so these portfolios for large cap, we saw slight outperformance in the last month. Although the portfolio did negative 1.4% return, it on a relative basis, it outperformed the Nifty 100 by 1.5%. However, if you compare the performance since inception, the performance has been pretty bleak with a negative 10.9% performance. If you compare the mid cap performance, it has been negative. So we did negative 3.3% excess return last month. And since inception as well, we have not been doing well in this portfolio. For small cap, things are slightly better. Although we did lose out last month, we generated 1.4% negative performance. However, Nifty small cap 250 generated a negative 5.8%. thus a positive excess return of 4.4%. And since inception also, although the portfolio has done worse, minus 4.3% in absolute terms, on a relative terms, it has generated a very minute outperformance. Now, we regularly try to produce YouTube videos and blogs to educate the investors. One of such video we have made live just today. So it is about information ratio. SEBI had mandated the disclosure of information ratio to all the mutual funds. It's a really important ratio. In fact, in our quantitative investment methodology, this is our objective function. We try to optimize for information ratio. So we select the portfolio based on which portfolio is going to deliver the highest information ratio. So this is one of the most important ratio that you should look in while comparing any portfolio, not just mutual funds, but also small cases or any portfolios that you want to invest in. It basically tells you whether the investment returns that are being generated by the manager, is it out of luck or is it really skill? So you should definitely check out this video after this webinar. Another video that Vivek has done. Vivek has an extensive experience in trading. He has spent nearly a decade of his life trading energy derivatives. And in this video, he shared a story, a very interesting story, where he shared that uh, his biggest win as a trader was, in fact, his biggest mistake. It's a very interesting story where he shared that he took a bet and that bet didn't turn out in his favor. The market was going against his bet. However, he was too emotionally immature to book that loss and respect the stop loss trigger that was happening. However, due to luck and sudden market event, geopolitical event, the market turned around and the mistake that he was grinding on actually turned out to be a really big win. And he ended up making more profits from that single trade than he did in an entire quarter. So you should definitely check out this video as well. And another video that Vivek has done is he has shared three books that has the most influential impact on him in reshaping his market views. So you should definitely check this video also out. Coming to the last segment of this webinar, it is Ask Me Anything. So I'm going to be addressing some questions that I have gotten previously from our investors via Google Form. So Sumit is asking us, I have been a subscriber for 5 years. There was no discount offered for the completion of 5 years. Also, while while compounding is known to work in the long term, how does it work when we keep buying and selling the five stocks every month as part of the rebalance? So, Sumit, thank you for being a subscriber for 5 years. It means a lot. And we did offer quite a lot of discounts for our existing investor as part of our loyalty program. In fact, I think we offered 40% discount. I don't know how you did not got that, but I think you should definitely reach out to us, although that offer has expired now, but we will definitely try to give you some sort of discount for being such a loyal customer. And addressing your second part of the question, see, Sumit, it's you are missing the point here. The point with compounding is all about spending time in the market. So we have different approaches to investing. So we have traditional buy and hold investors like Warren Buffett, who just buys the stock and forgets about it and holds it for eternity. Our investment approach is not that. Our investment approach is more quant driven. So what we do is we analyze the data of the market and try to construct the portfolio. So any sort of quant strategy which is actively trying to create the portfolio based on market data is going to have a high amount of churn. So we are going to have a month-on-month churn, although we have tried to reduce the churn uh, due to respect the investors and reduce their transaction cost. But still, I think right now we are at 25% month-on-month churn. Earlier, it was as high as 60%, but we have reduced the churn, monthly churn to 25% now. However, the important part is that 100% of the time we are staying in the market. So we are not missing out. We are not timing our entry and exit out of the market. So every month when you're rebalancing, you're still in the market. Your money is still invested in the stocks. It's just next stocks, which are based on different criteria, different factors. So I hope I have answered your question. Coming to the next question, Lijo is asking us Gear 6 historically rebalanced on the first working day of every month. However, for the last two rebalance were triggered on the last Monday of the month. Is there a reason for this schedule change? So, Lijo, I have to really commend you on your observational skills. It's pity you have rightly pointed out that we have switched the rebalancing schedule, and there is a reason behind it. Historically, we had been doing it, as you have mentioned, at the first trading day of every month. However, as you know, we also have our PMS as well. So, we had to realign the rebalancing schedules for both the PMS clients as well as the Gulaq retail clients, such that the investment advice that is releasing from the same research team, the research team for the Gulaq as well as for the PMS, they are both the same. So it was important for us, in spirit of fair dealing, that both the research team releases the information, releases the investment advice, the portfolio at the same time to both the Gulaq clients as well as the PMS clients. And because we take care of the execution for PMS ourselves, we had to maintain some sort of margin beforehand. And that is the reason we are doing the rebalance on the last Monday of every month as of right now. As of right now, this is the structure. If there is going to be any change in this, we are definitely going to inform all our investors in advance. Coming to the next question, Pawan is asking, I have invested 30 lakhs in this small case. Can this grow to 3 crores in the next 10 to 15 years? So, Pawan, this is definitely possible. See, going from 30 lakhs to 3 crores is a 10x jump. And 10x jump in 10 to 15 years is extremely reasonable. So, if you had to do it in 10 years, you would need to generate somewhere around 25% CAGR. And if you had to do it in 15 years, you have to generate somewhere around 16% CAGR. This range is well within our target range. So BSE 500 is our benchmark, and BSE 500 generates anywhere around 12 to 15% annualized return over a long period of time. And our goal is to produce 5 to 8% alpha, at least 5 to 8% outperformance over what BSE 500 is producing. So if you do the math, it's well within range. And historically, if you compare our performance of how we have been doing over the last 5 years in Gulaq and over the last 7 years in PMS, this is very realistic. In fact, we have been doing much better than 5 to 8% outperformance that we communicate to our investors. But still, we want to be grounded and conservative in our long-term approach towards market. And any return over 20% over a long period of time is phenomenal. So I think this is definitely the right portfolio for you if your goal is to invest for the next 10 to 15 years. I think you can definitely increase your odds of winning if you increase your investment horizon. Next question we have from Baljeet Singh. He's asking, I have been investing in Gulaq Gear 6 for 2 years and always rebalance within 2 to 3 days. My XIRR is 2.75%. These returns are not very motivating. Kindly suggest how to improve this. So, Valjit, when I saw this comment, I was very surprised because Gear 6 has produced somewhere around 20 to 25% over these last 2 years. Over a 2 year period, we have generated around 20 to 25% returns. Now, of course, what a fund publish is a time weighted return. It's a CAGR return. So it produces key if you had invested 2 years ago, what that money would be today. It does not consider the intermediate cash flows. So investors oftentimes what they do is they don't just invest one time and then leave the money in the portfolio and sit out. They invest periodically in via SIPs, and they sometimes withdraw the money, they invest more and things like that. So from looking at this XIRR, my guess is what would have happened is that uh, you would have invested in the portfolio and had continued when the rally was going, and would have might have invested more when we were seeing a portfolio downturn. So you were experiencing gain on a smaller capital, and then you decided to invest more money, and then the portfolio started declining. So you saw loss on a bigger capital and saw gain on a smaller capital, and thus your total gain is coming out to be underwhelming. However, this is just a guess. I would highly suggest you to request an order book from Smallcase and send us your order book as well as the screenshot of the return that you're seeing on your terminal. I'll definitely make sure that I personally analyze your portfolio and recommend you if there is anything that you need to improve to make sure that your tracking error is not as high. Going to the next question, Suparva is asking us, I want to invest an additional 5 lakhs. Should I invest in monthly? Should I invest it monthly or as a lump sum? What is the maximum amount I can invest? So, Suparva, there is no right answer for this. It totally depends on your personal preferences. If you ask me from a purely rational purpose, several studies have shown that investing in a lump sum is better than investing instead of delaying the investment and investing periodically in SIPs, because money is not free. There is an opportunity cost associated with it. If you invest all of that money that you have right now, then all of that money is working right now. If the market goes up, then you're going to earn on that money, and also vice versa. If the market goes down, you're going to lose out. But the important thing is that the money is working for you right now. However, if you decide to not invest this money and decide that you should invest it systematically via a period, then what is happening is you are missing out on those returns. So, from a purely rational perspective, lump sum is often the better way of investing rather than keep delaying your investment and investing it, delaying your investment and investing it later on. However, there is also emotional aspect to it. If you invest all of that money right now and suddenly the market crashes, then you're going to lose out on such a big capital and you're going to be cursing me. So it is important to consider the emotional aspect as well. In fact, Daniel Kahneman, a well-known behavioral finance researcher, in his 1970s prospect theory paper, proved that we humans are extremely loss averse. So the pain that we experience from a loss is twice as much as the joy that we experience from a gain. So, as humans, we are built to avoid the pain, and hence it is much less painful. SIP investing periodically over a long period of time is emotionally less taxing. So, you just have to reflect which approach is best for you. So, if you are a person who don't want to take that emotional pain, if the market changes the direction and suddenly falls 5% or 10%, then it's best that you invest systematically over a long period of time. Otherwise, you can just put all of that money in one go in lump sum. To address your second question, what is the maximum amount of money you can invest? So we always recommend our investors to not invest more than 50 lakhs in our portfolios, in our Gulaq portfolios, because at 50 lakh you become eligible to be a PMS client. So with PMS clients, we take care of the execution, the slippage is much less, and the portfolio is much more diversified. At Gulaq, we just have like 15 stocks, but at PMS, we have like 80 to 100 stocks. So the chances of outperformance in a PMS is much higher. And we have a good track record to back it up. So if you're interested, please visit our Gulaq website. You're going to find a PMS section there and just leave your contact details, and our PMS team is going to reach out to you and see how we can help you out. Next question is from Amit Shukla. He has two questions. He's asking, can you explain how weights are assigned to different factors like value and momentum each month? Are these weights decided algorithmically or manually? How much human involvement is there in stock selection or deciding factor weightages? So, Amit, our investment methodology is purely quantitative. So, we do not have any sort of human subjectivity or somebody taking intuitive call. So, there is nobody who thinks ki, Arey, aaj market is going to do this, so I should pick this stock or that stock. So, none of that is happening. Our methodology is very strict. So, we follow a quantitative factor-based methodology where what we do is we first assess the market regime, and based on the market regime, we identify which factors are going to work in this market regime. For example, in this market regime, in the current market regime, as I showed you guys earlier, we had allocated to value and quality. So in this market regime, we think that value and quality are going to do better. So we have allocated weights to these factors, and we have identified these factors, and in on the universe, on the investment universe, which is BSC 500, we score each and every security using these parameters, using these factors, and create a portfolio which has the maximum composite score. So everything is algorithmic, everything is defined, nothing is manual or subjective. Going to your second question, you're asking what is the probability that a code bug skews the stock selection in in a particular direction, positive or negative? How do you mitigate such risk in quant strategies? So what you are referring, Amit, here is the operational risk that every quant strategy has, and definitely we look into it and address it. So what we do to address is basically we have operational checks and alerts. So anytime the algorithm is behaving not as per the rule or as intended, then we get an alert, and the concerned team looks into it diligently and promptly. So we have not had any major instances where we had a code bug or any sort of operational problem which has skewed the portfolio selection process. Amit again is asking, what is the stock universe used by the algorithm? Is it NSE 500 or focused group? If it is focused group, how is it selected? Also, how many stocks are considered each month? Is the algorithm connected to live data feed, or is it updated monthly? So the stock universe, as I have mentioned earlier, Amit, is BSC 500, which is the same thing as NSE 500 for gear portfolios, and for market cap portfolios, it's their respective market cap. And there is no focused group that we select. We select the stocks from BSE 500. Each stock is scored individually, uh, and algorithm is not connected to live data. We have to run the model because live data, there is a lot of noise in the live data. So we cannot just take the live data as it is. We have to do quite a lot of cleaning, and in fact, that takes a majority of the time for portfolio construction. So we have to take the data from Bloomberg, clean it, spend some time in it, run the model, run our proprietary factor-based model, and then construct the portfolio. So it is run every single month, and it's not connected to live data. Going to the last question, Rajesh is asking. So, Rajesh, we don't specifically just look at free float. Of course, liquidity, we check the liquidity of all these stocks and make sure that the stocks which have decent liquidity are getting included in the portfolios. And for majority of the
Uncle, I lost you for a minute back there. I'm not sure if it's my internet or if everybody else
Yeah, sure.
also
No, it was
faces
the
issues.
internet problem from my end. Let me just share the
Yeah,
screen. Let me know, Simran, when did when was I not audible? Till where did we covered?
I think we can cover the last question again. Apart from that, I think it was good.
Okay. Okay. So the last question was by Rajesh. He was asking about what does the leverage factor in your multi-factor model mean, and when is it used? So again, we look at the market regime and try to assess which factor is going to perform well in this market regime, and based on that, we allocate the factor and we pick the parameters of that particular factor and score the investment universe. And with respect to your question regarding what does the leverage factor mean, leverage is basically, we try to select the stocks which have low debt. So we have some proprietary measures and we have some, it's like debt to equity ratios. We try to look at stocks that are investing more conservatively. So it's an extension of the quality factor. That is it with the presentation. We can take the live questions now. Simran, over to you.
Yeah. So we have a couple of questions from our audience. So the first question is by Rajat Dumir. How to choose between market cap portfolios by Gulaq versus the gear-based portfolios? Maybe I can take that up. So, to break it down simply for our investors, our gear portfolios are actually market cap and sector agnostic. So, what it means is that we don't just limit ourselves to a certain segment of the market, but instead we look for the best opportunities across the market based on our proprietary quant model. So the model doesn't care where the stock comes from, it only cares how strong it ranks in its factors. So, in that sense, the gear based portfolios are like a complete all weather kind of solution where everything is taken care for you. Now, if we talk about the market cap portfolios, which are Gulaq large cap, Gulaq mid cap, and Gulaq small cap, these are more focused. So they specifically pick stocks from a certain segment of the market cap. So large cap portfolio looks at top 100 companies by market cap. Mid cap looks at 101 to 250, and small cap picks stocks above 251. So if you're someone who wants a targeted exposure, like say you're bullish on the small cap for the next 2 3 years, like this is just an example, it's not an advice, but if you're bullish on small cap for the next couple of years and you want to focus on that, the market cap portfolios allow you to do just that. um, Now, addressing the question that which one is right for you, it depends on what kind of investor are you. So, if you're someone with a little bit more of experience and you want to take your own calls and want a more DIY approach, you can definitely go for the market cap portfolios. But if you're someone who is recently started investing and want an optimized and diversified kind of portfolio, we would recommend that you get gear based portfolios based on your risk appetite. So, Ankit, do you want to add anything to that?
Yes, Emily, you have perfectly summarized the entire entire consideration that an investor should look when comparing the choice of investing between gear-based portfolios and market cap. I would say it's just simple. If you are a very aggressive investor and want to take a very high risk, high return type of exposure, then small cap is for you. Otherwise, if you want to slightly tone it down, then you can take large cap exposure. Otherwise, if you want just you don't want to make those decisions whether I want a small cap or a large cap, you can just go for Gear 6. It's a flagship portfolios. It's unconstrained by the market cap. So, in terms of information ratio, it has the highest information ratio amongst these portfolios. So if you're just comparing from a risk adjusted perspective, you should go for Gear 6. Otherwise, of course, if you're a more aggressive investor and seeking slightly higher return, you can go for small cap portfolios. Otherwise, conversely, you can go for large cap portfolios.
So, moving on to the next question, it's from Apur. Redington part of our portfolio has been down 20%. Can you share what was the thesis behind the selection, if we can expect a rebound or better get out of it?
Yeah, definitely. The thesis was the same thing, same that we have been following for the past 5 years. At its core, we are following factor-based investment methodology. It's purely quantitative, and we have followed it consistently over the past 5 years in Gulaq and over the past 7 years in PMS. The only difference is sometimes the portfolio performs really well, sometimes it does not. So right now we are questioning, it's not performing well, but it the same methodology was performing well, over the last 5 years. So I think in markets, the 6 month, 12 months is very short period of time to evaluate an investment strategy effectively. It's very important that we have a more longer term perspectives when it comes to equity market and approach it more rationally and not just chase after the performance, after the short term performance. Because oftentimes what happens is the portfolios, seasonal portfolios that are doing well right now, they might not be performing well, in the coming next months, but you might have forgotten about it because you are looking at the portfolios that are doing well at that time. So you should not be a performance chaser. You should not fall to that bias and look at more objectively over a longer period. And I think we have performed pretty well over a long period of time. And recently, I agree, we have not been performing well, but uh, we are confident that over a long period of time, we would come out on top.
Uncle, I think we lost you again.
Uh,
Yeah.
Sorry, how much did you hear?
I think you were just trying to sum up the question. But yeah, we got another question from her. That question is basis your analysis that should we hold or should we sell
Should we hold or should we sell what? The
the
portfolio?
Redington? Yeah.
Yeah, you should definitely hold. You should never try to time the entry and exit into the markets. It's very unpredictable what's going to happen next. Nobody can predict. Around, I think January and February, market was so down. Large cap and red caps were 10% down each month. And the pessimism was extremely high. People were saying that we should withdraw from the investment, we should stop the SIPs. But now the market has recovered. So if you had withdrawn if you would have pulled out the money at the bottom, then you would have never seen the recovery. So it's important that you stay invested throughout the time period so that you are able to enjoy both the downs and the ups of the market. Of course, you're not going to enjoy the downs, but you are not missing out on the ups when the market eventually turns around. So it's important to always stay invested in the market.
I hope that answers your question, Apurva. The next question is by Segu. Uh, oh, this message was retracted. So, just waiting if anybody else has a few more questions, or we'll be waiting for a couple of minutes. You can drop down any questions that you have about a product, about maybe PMS, or if you have any suggestions or any feedback for us also, we would really like if you can just drop in your comments. Just waiting for more questions. Okay, so we got one question, or this one's from Anuradha. Within how many days am I required to respond and communicate my intention to rebalance the share allocation after receiving your email requesting a rebalance?
As soon as possible, if you want to minimize the tracking difference between your own portfolio's return and our model portfolio returns, then you should rebalance it immediately. So as soon as you get the notification, you should rebalance it as soon as possible. Otherwise, the tracking difference keeps increasing, especially because we have quite a lot of small cap stocks, which has high impact cost. So day on day movement quite can be quite huge. So you might miss out on the alpha if you decide to not rebalance the portfolio immediately and suppose delay it by a week or 10 days. So to minimize the tracking difference, it's always advisable to rebalance it as soon as possible the same day.
That was the last question that we have since we are not getting. Okay, we just got another one. So Anuradha is asking another thing, that is it permissible for me to sell the shares that have appreciated in value?
Yeah, definitely. Why not? You should stick to your investment methodology and not not succumb to these psychological biases. So there is often a bias, loss aversion bias, which I spoke a little bit about during the webinar. So what people often do is they try to book the gain when they see the stock rising. However, if they are losing out on the stock, then they try to hold on to it anticipating that it's going to turn around. So it's a very common bias. It's called loss aversion. It was coined by infamous Daniel Kahneman in his 1970 prospect theory research paper. And it just suggests that as human beings, we are very averse to losses. So we don't want to face the loss. We want to avoid it as much as possible. So when we are in a situation when we are facing a loss, we always try to avoid it and just try to hold on to it in anticipation that it's going to turn around. So if you're not booking it, then we are not realizing it, and we are avoiding that pain that we are going to experience from booking that loss. So it's important that you don't succumb to these biases and follow your strict approach to investing, whether it is gain or whether it is loss. If you stick to a disciplined approach to investing, you're going to have a much better outcome over a long period of time.
Okay, so that was the last question for the evening. So thank you so much everyone for joining. Thank you, Ankit, for your time. And we shall see you in the next AMA session.
Thank you so much.